There's a tricolor dealership in Mesa, Arizona, with a chain on the front gate and a stack of certified mail piling up against the glass door. 3 weeks earlier, that lot was moving trucks every single day. Then the company that financed most of them collapsed overnight, and now there's a tow truck idling out front with nowhere in particular to take the truck it just hooked up. Nobody stole anything. Nobody crashed. The headline you clicked on says millions of Americans are returning their new trucks in 2026, and by the end of this, you'll understand that the real story isn't a return at all. It's a lending system with cracks running from the driveway all the way up to the banks that funded it. The claim everyone repeats. I'll be straight with you because that's the deal on this channel. You cannot return a truck. There is no return counter at a dealership anywhere in America. Once you sign the paperwork and drive off the lot, that sale is final, no cooling off period, no 3-day grace window, no receipt to bring back. That law people assume exists for cars simply does not exist. So no, millions of people are not walking into a Ford store and handing the keys back over the counter like a sweater that didn't fit. What's actually happening is stranger and more layered than a simple return, and it's happening on 2 levels at once. On the ground level, individual buyers are getting swallowed by loans that were stretched past the point of survival, and the truck comes back to the bank one way or another, whether that's a trade-in gone wrong, a phone call to the lender, or a tow truck showing up unannounced. On the level above that, a chunk of the machinery that funded those loans in the first place quietly broke, and it broke loud enough that regional bank stocks wobbled and United States senators started sending letters. The word returning is doing a lot of work covering up both of those stories at once, and tonight we're going to pull them apart. I'm not going to hand you a headline and call it a day. We're going to look at the actual loan numbers straight from the people who track every single new vehicle sale in the country. We're going to look at exactly how a truck goes from a driveway back to a lender. And then we're going to look at the part almost nobody covered properly, the specific company whose collapse this past year tells you more about where this is all headed than any single repossession story could. And look, I understand why the headline writers reach for the word returning. Millions of Americans are quietly handing debt back to a truck reads like a phrase written by an accountant, and nobody's clicking on that, myself included. But the actual mechanics underneath it are more interesting than the fake version, and once you see how many separate things are hiding inside that one misleading word, you won't look at a dealership finance office the same way again. One more thing before we get into the numbers, because it matters for how you read everything that follows. I'm not a financial advisor, and I'm not your accountant, and nothing here is a recommendation to do anything specific with your own loan. What I am is somebody who reads these industry reports the day they drop, because half the story that actually matters lives in a press release nobody outside the car business bothers to open. Let's open it together. The 2 lines. Racing each other. Here's the foundation, and without it, nothing else in this story makes sense. Every truck loan in America is a race between 2 lines. The first line is what the truck is actually worth, and it only moves in one direction down. The second line is what you still owe on it, and it comes down far slower than most buyers expect. The industry calls the gap between those 2 lines negative equity. Forget the term. It just means you owe more than the thing is worth, which is a sentence that sounds obvious until you're the one living inside it. Here's why the gap opens in the first place. The moment a new truck leaves the lot, it starts shedding value immediately, often losing a meaningful chunk in the very first year alone, sometimes before the new car smell has even faded out of the cab. Your loan does not care about any of that. In the early years of any loan, the majority of each payment is interest, not principal, which means you're renting the money before you're actually paying down the truck itself. So the value line drops fast while the debt line drifts down slowly. And for the first several years of a long loan, the truck spends nearly the entire stretch, worth less than what's owed on it, sometimes by a wide enough margin that trading in feels less like an upgrade and more like handing over a hostage. This used to be a much smaller problem, back when the typical truck loan ran 3 or 4 years, the kind of term your dad probably had without ever once thinking about it. A short loan pays down principal fast enough to stay ahead of depreciation almost automatically. The trucks didn't suddenly start losing value faster than they used to. What changed is the loan wrapped around the truck, stretched longer and thinner than it's ever been stretched before, and that's the machine we're actually taking apart tonight. Not the engine, the paperwork, because the paperwork is the part that's failing. Run the actual math for a second because it's more concrete than it sounds. Take a $65,000 truck, $6,000 down, financed at 7% over 84 months. In year one alone, that truck can easily shed $10,000 to $15,000 of value, while the payments barely touch the principal because the interest eats the front half of the loan almost entirely. By the end of year two, it is completely realistic for that buyer to owe $10,000 more than the truck would fetch at trade. As long as they keep the truck and keep paying, that gap stays a number on a piece of paper nobody looks at. The depreciation curve slowly flattening out while the principal payments quietly start speeding up in the back half of the loan. The moment life happens, a job change, a medical bill, an insurance premium that jumped 40% for no reason anyone can fully explain, the gap becomes very real. And there's no selling your way out of it because selling doesn't pay off the loan. You'd have to sell the truck and then write a check for the privilege of no longer owning it. The numbers behind the record start with the price because everything downstream flows from it. The average transaction price for a new full-size pickup crossed $65,000 this spring, according to Kelley Blue Book, while the average new vehicle overall sat closer to $49,000. That's not steel getting more expensive. That's the honest, stripped-down work truck all but disappearing from dealer lots, because there's barely any margin in it compared to a loaded crew cab wearing a trim name borrowed from a mountain range. 20 years ago, a pickup was a work tool with vinyl floors and crank windows. Walk a modern lot looking for that truck today, and you'll find it mostly in the brochure photography, not on the actual asphalt, which is a strange thing to say out loud, but it's true of nearly every lot I've walked onto this year. Now watch what buyers do when the price outruns the paycheck. They don't buy less truck, the sales numbers make that painfully clear. Instead, they stretch the loan. According to Edmunds' own second quarter data for this year, released in July, nearly a quarter of all financed new vehicle purchases, 23.9%, carried loan terms of 84 months or longer, a new record. Widen it out, and 36.5% of buyers went past 72 months, another record, way up from 27.3% a decade ago. The average loan term across the entire market is now over 70 months, which means the typical new truck buyer today is financing something closer to a mortgage timeline than the 3-year note their parents would have laughed at extending. At the same time, down payments are shrinking. Buyers put down an average of $5,815, just 11.6% of the purchase price, the smallest share since the third quarter of 2020. The average amount financed hit a record $44,156, and that's the market-wide average, meaning truck-specific financed amounts routinely run well above it, given how much more the truck itself costs to begin with. And here's the number that should genuinely bother you. 1 in 5 financed new vehicle purchases, 20.3%, now carries a monthly payment of $1,000 or more, tying the all-time record. The average monthly payment across the whole market hits $777, a record for the third quarter running. Pair a 7% interest rate with an 84-month term, and Edmunds' own director of insights says you'll hand over close to $10,000 in pure interest over the life of that loan. $10,000 paid to the bank for nothing except permission to make the payment number look smaller on the sticker in the finance office. None of this is happening in a vacuum either. Last fall, J.D. Power reported that nearly 14% of new car buyers had credit scores below 650, the highest share since 2016, which tells you the pool of people stretching into these loans includes a growing number who were shakier candidates for one to begin with. And it's happening while the Federal Reserve has held its benchmark rate in a range around 3.5% to 3.75%, high enough that auto loan rates haven't come down meaningfully, even as buyers get squeezed from the price side of the equation as well. Two pressures pushing from opposite directions, and the loan term is the only lever left for a finance manager to pull. The 3 ways out that all get called returning. So when a truck owner hits the wall those numbers describe, there are really only 3 doors, and every single one of them gets loosely called returning the truck by somebody. Door 1 is the underwater trade-in. Edmunds' latest figures show 29.6% of all trade-ins toward new vehicles in the second quarter carried negative equity, the highest second quarter share since 2020, with the average underwater balance at $6,884. The dealer rolls that unpaid balance into the new loan, so a buyer trading in a truck they owe more on than it's worth walks out already underwater on day one of a brand new contract, before the new truck has lost a single dollar of its own value. It's the financial equivalent of paying off one credit card with another one and calling it a fresh start. Edmunds found buyers who roll negative equity forward end up paying an average of $944 a month, $167 above the market average, and are projected to pay over $16,000 in interest across the life of the new loan, roughly $6,500 more than a typical buyer. And this isn't limited to cheap depreciating vehicles. Some of the highest negative equity dollar amounts this year showed up on trucks and SUVs specifically known for holding their value well, Ram 1500s, Jeep Wranglers, and Toyota Tundras among them, with some Tundra owners rolling close to $9,000 of old debt into their next truck. Door 2 is the voluntary surrender, calling the lender and handing the truck over before anyone comes looking for it. It feels honorable, and in a way it is, but the mechanics are rough, and I'm not going to lie to you about them just because the phone call was polite. The truck goes to a wholesale auction, sells for well under retail because the buyer needs margin to recondition it, and whatever's left after towing, storage, and auction fees gets subtracted from the balance. What remains is a deficiency, and it is still very much your debt sitting on top of a credit report hit that behaves exactly like a repossession for years afterward, whether you handed the keys over yourself or not. Door 3 is the one nobody chooses, the involuntary repo, and this is the door swinging hardest of anywhere in the country right now. Subprime auto delinquency hit 6.9% this past January, according to Fitch Ratings, the highest level in 32 years of tracking dating all the way back to 1994. Compare that to prime borrowers, the ones with strong credit, who are sitting at somewhere around 0.4%, a gap of more than 10 times between the two groups. Vehicle repossessions climbed past 1.7 million last year, the most since 2009, which was the floor of the Great Recession, and total outstanding auto loan balances reached $1.69 trillion in the first quarter of this year, according to the New York Fed, with nearly 5% of that entire pile sitting in some stage of delinquency at quarter's end. There's a corner of this market worth naming specifically, the buy here, pay here dealers, the ones who sell you the car and hold the loan themselves instead of sending it off to a bank. Federal Reserve research published this past spring found that nearly 78% of that segment's lending goes to subprime borrowers, compared to about 27% for traditional lenders, and that loans in that segment are more than 16 times as likely to be sitting in active repossession status at any given moment. Roughly 5% of buy here, pay here balances were in active repossession last fall, compared to well under 0.5% for a typical bank loan. That's not a rounding error. That's an entire business model built around a much higher tolerance for taking the car back. Follow the money. None of this is an accident, and it isn't a conspiracy either. A dealership doesn't make its real money on the truck itself. The margin on the metal is thin. The profit lives in the finance office, in the origination, in the rate markup, in the extended warranty stapled onto the contract while you're signing your name for the 4th time and not really reading page 6 anymore. There is very little money in a buyer who puts 20% down, finances 60 months, pays the truck off, and drives it for another decade. That customer is, from a pure business standpoint, a disappointment, a one-and-done transaction that never generates another dollar of interest. There's a great deal of money in a buyer who stretches to 84 months, comes back underwater in 3 years, and rolls the shortfall into another 84-month contract. That customer never leaves. That customer is closer to a subscription than a sale, and once you start looking at the industry through that lens, the 84-month loan stops looking like an accommodation and starts looking like a retention strategy with a windshield attached. Ivan Drury, Edmunds' own director of insights, put it about as plainly as an industry analyst ever puts anything, saying flatly that this is a financing problem, not always a vehicle choice problem, and that leaning on longer terms as a coping mechanism only guarantees more interest paid in the long run. Nobody in the finance office is twirling a mustache about it. It's just quiet arithmetic, 1,000 small decisions, where the number that gets chosen is the one that protects the lender's margin, not the one that protects the buyer's balance sheet, repeated across enough dealerships and enough finance offices that it stops looking like individual choices and starts looking like an industry. And the payment itself, that clean 4-digit number on the sales sheet, is designed to be the only figure most buyers ever actually look at, because the payment can always be massaged smaller with 3 more little words from the finance manager. Just extend the term. It sounds like a favor. It's rarely one. Ask for the total cost of the loan instead of the monthly number, by the way, and watch how the conversation slows down. That's not paranoia. That's just a genuinely useful trick for your next visit to a dealership, and it costs you nothing but a slightly awkward silence. The crack nobody was watching. Now here's the part of this story almost nobody covered properly, because it happened one level up from the driveway in the wholesale funding machinery most car buyers never think about. In September of last year, a subprime auto lender and used car retailer called Tricolor Holdings, running around 65 dealerships across Texas, California, Nevada, and Arizona, filed for Chapter 7 bankruptcy and simply shut down almost overnight. This was a company that had generated close to $1 billion in revenue in each of the 2 prior years, and was carrying more than 60,000 outstanding car loans at the moment it collapsed, financing a customer base where, by the company's own disclosures, over 2/3 had no credit score at all, and more than half didn't hold a driver's license, exactly the population that has the least room to absorb a shock like this. The reason it fell apart wasn't simply affordability pressure working its way through one more used car lot. Warehouse lenders discovered what investigators are now calling a systematic fraud scheme, collateral allegedly pledged twice over to different lenders against the same loans, data irregularities buried in loan tapes and audited statements. In the weeks before the filing, most of the company's workforce had already been quietly placed on unpaid leave, told they'd learn within days whether they still had jobs at all, while the company's own chief executive resigned from the board of one of the banks that had lent it money. A detail that in hindsight reads like someone who already knew exactly which way the wind was blowing. By December, federal prosecutors had indicted the company's founder and its chief operating officer directly, in an indictment describing a scheme prosecutors say stretched back years. JP Morgan alone booked a $170 million loss tied to the collapse, and it wasn't just Tricolor. An auto parts maker called First Brands went down in a separate bankruptcy just 2 weeks later, close enough together that lenders started openly wondering whether the private credit propping up the whole auto sector had more holes in it than anyone had priced in. Regional bank stocks wobbled hard in the days after, one bank dropping more than 13% in a single session, because investors suddenly weren't sure how many more tricolors were sitting quietly inside other banks' loan books, undiscovered. Senators Elizabeth Warren and Jack Reed sent a letter to federal regulators demanding immediate action, and by February of this year, Warren had opened a formal inquiry into the entire auto lending and repossession industry, writing directly to major lenders and to companies that specialize in the buy here, pay here model, the segment of the market that lends almost exclusively to subprime borrowers and sees repossession rates many times higher than a traditional lender's. That's the layer underneath the layer. It isn't just that individual buyers are underwater on their trucks. It's that a meaningful slice of the machinery funding those loans was built on assumptions, and in at least one very large case, outright alleged fraud that came apart the moment anyone looked closely enough to check. The honesty chapter. What the skeptics get right now. I have to be the guy who steps on his own story, because that's the deal here too. The headline version of this, millions of Americans returning their trucks, oversells what the data actually shows, and I'd be doing exactly what those headlines do if I let the scariest number stand without the context around it. Negative equity share in the second quarter of this year, 29.6%, was actually down from 30.9% the quarter before, and the average dollar amount owed, $6,884, was also down from the prior quarter's figure. This is a serious worsening trend on a multi-year basis, but it is not a straight line getting worse every single month, and treating every quarter as a fresh record ignores that it occasionally ticks the other way, which is a detail a lot of the coverage conveniently left out. It's also worth being honest that the tricolor collapse was driven specifically by alleged fraud at one company, not by the broader truck market falling apart on its own. The overwhelming majority of auto lenders were not double pledging collateral, and prime borrowers, the ones with strong credit, are showing delinquency rates sitting near 0.5%, a gap of more than 10 times versus the subprime borrowers carrying almost all of this pain. If you've got decent credit and a loan you can actually afford, none of this quarter's headlines are really describing your situation, whatever the thumbnail implies. Economists studying this have also pointed out a real structural difference from 2008 worth sitting with for a second. Car loans aren't bundled and leveraged into the wider financial system anywhere near as heavily as mortgages were back then. And unlike housing prices in that era, vehicle values have been holding relatively steady rather than collapsing underneath borrowers, which makes a repeat of a full-blown financial crisis considerably less likely even as individual households genuinely suffer through it one driveway at a time. So the fair version of the story sits somewhere in the middle. It isn't millions of ordinary truck owners walking away from perfectly fine trucks on a whim. It's a much smaller, much more concentrated population of buyers, disproportionately subprime, disproportionately stretched into loans that were never built to survive a bump in the road, running into a lending system that had its own quiet cracks running through the middle of it, cracks most of them never had any way of seeing from the finance office chair. That's a real problem worth taking seriously. It's just a different, more specific problem than the headline implies, and specific problems are usually the ones you can actually do something about, which is a far better place to end up than a vague sense that the whole economy is coming apart. The closing reframe. So here's where I actually land on it, standing in front of that chained gate outside a shuttered dealership that was selling trucks 3 weeks earlier. The word returning was always the wrong word, but it was the right instinct. Something really is coming back over and over in this market. It's just not the truck. What's coming back is the bill for a decade of choosing the smallest possible monthly number over the true total cost at every single link in the chain, from the buyer signing an 84-month contract because it was the only way the payment fit, to the finance office that quoted that payment without ever once volunteering the total, to the lender bundling loans it apparently never fully verified before selling them off to the next investor down the line. The truck in the driveway was never really the product. The renewed contract, the refinanced balance, the rolled over debt, that was always the product, dressed up in a bedliner and a set of running boards so it would feel like you were buying steel instead of a decade-long relationship with a payment. And for a growing number of Americans this year, the bill for a decade of that arithmetic finally came due at the same time from both directions at once, from the driveway and from the boardroom, on the same trucks in the same quarter, almost like the two stories were always the same story wearing different clothes. Picture the two of them side by side for a second, because they really do rhyme. A buyer somewhere signs an 84-month contract because it's the only way the payment fits, trusting that the number on the sticker means what it looks like it means. A few states away, a lender books that same kind of loan onto its balance sheet and pledges it as collateral, trusting that the paperwork underneath it means what it looks like it means too. Neither one of them checked closely enough, and neither one of them had much reason to. Right up until the year both of those trusts got tested at once. So tell me in the comments, has this touched your family? Are you carrying a loan longer than you'd like to admit? Or did you watch a dealership near you go dark overnight the way Tricolors did? Tell me too, if you've ever asked a finance manager for the total cost of a loan instead of the payment, and what face they made when you asked. I read every single one of these, and half of what ends up in future videos comes straight out of what you tell me down there. If this one earned your subscription, stay close, because next time we're doing the one I've been promising, lifetime transmission fluid, the factories seal it, throw away the dipstick, and tell you it's filled for life. I'll show you exactly whose life they're talking about, and it isn't yours. I'll see you in the next one.